Deficit, it was presented last year of 13.39 trillion naira. But we'll see how that fundraising for that will impact yields in 2025. And let's talk to Chuka Nwachukwu. He's the Group Head, Asset and Liability Management, UBA. Good afternoon, Chuka. It's good to have you on the program.
Good afternoon, Will. Happy New Year.
Happy New Year to you too. Now, some asset classes I was talking about, it's about 30% in 2024 for some mutual funds. We saw them in the fixed income space. We do know that the equities market ended with about 37% for the year. But what are your expectations for 2025? Should market players be gearing up for an outperformance, especially now that the FG plans to fund the 13.39 trillion naira budget deficit from the debt market? If we look at the breakdown of that, we see that over 9 billion naira, 9 trillion naira is going to be sourced from 9 trillion is going to be sourced from the debt market, and we also see other plans for bilateral loans and raising from other sources. But what is your expectations for yields, especially now that we have this huge deficit to fund to fill in the gap, and how are market players going to be keying into this?
Thank you, Will. The expectation, like you mentioned, is that the government is going to be funding about 13.9 trillion, from the, 13.39 trillion from the, from the fixed income market. Throughout last year, the yields were highly elevated, and that is because government funding were mainly from the fixed income market. And of course, the government is looking to, to borrow. Of course, they have to make the yield attractive. And so we do not see that change, especially the first 2 quarters of the year. Government obviously is not getting enough funding from the, from the international market. Though towards the end of last year, they were very successful in terms of raising about $2.5 billion. The market expectation is that we see expected elevated yield, especially as the price stability which the CBN is trying to fight. We see elevated yield. We see that some of the indices that have caused inflation, like the fuel price increment, as well as the food inflation, will continue to play a major role. And so I do not think that the yield curve will change, especially like I said earlier, the first 2 quarters of this year. So we expect to see the yield slightly elevated between 18.5 to 22.5% on the longer end of the curve. That's the 1 year for the bill. Also, we also have to keep an eye on what government is also trying to do as regards tax, of course, and also improving production, because if the production is improved and then tax is also increased based on what the president is currently trying to do, we see that the pressure will be eased on the revenue from oil, and that will really help us greatly. Another aspect of things that we also have to look at for is the refinery. The refineries, if they are producing in optimal capacity, that will also ease the pressure on the FX side. So we expect to see exchange rate stable, from towards the end of the second quarter of this year, and then the third quarter we expect to see stability at the exchange rate, and of course the yield, will then now continue to climb as expected, starting from the first quarter, towards the end of first quarter, and then the last end of the second quarter.
Okay, talking about these projections you've made now, especially stability in yields and possibly elevation in yields, but being stable, and also for the FX market. Let's also consider the inflation target of 15% that the government is proposing in the budget. Do you see this, especially you talked about the refinery coming on board, you talked about production, you talked about the proposed tax reforms, and then that ease on businesses, for businesses. Do you see the 15% target as feasible for the government, for Nigeria, especially with the fact that food inflation is still skyrocketing and production is not as, we don't have enough production to be able to match that, the impact or the pressure the Naira has in terms of chasing the dollar for, importation?
Well, 15% from about 33.9% is a tall order, but I personally don't think it's not doable. But then it's going to be very difficult. However, there are some parameters, like I listed earlier, that will greatly affect the inflation figures. What I mean affect it positively. Like I said earlier, if we're able to tackle the oil theft in the Niger Delta and then maintain optimum production, currently we're producing less than 1.5 a million barrels per day, which obviously is a far cry from a projected target of 2.2 million barrels. So that will definitely affect. Now oil, with the refinery, performing optimally, if everything goes well, that also will help. Because you see, if you look at the drill down to to the core aspect of inflation, you see that the major culprit there is the food inflation, and then of course the FS inflation. So we need to tackle food inflation. Now, how do you tackle food inflation? We need to produce more. We're not producing more, and then because of insecurity, and so that's why I've always said and often time that look, our major problem is not solely on the monetary aspect, is the physical aspect. Because if we're able to address the insecurity, especially as affects the farmers, it will help to improve production in terms of farm produce, and then of course food inflation will begin to come down. Then, of course, on the FX inflation, major concern is the fact that we're still importing oil, and then so if the refinery is addressed, that will obviously reduce pressure on the demand. And so, yeah, if all these aspects are addressed, which obviously 80% is a fiscal issue, and then we can begin to say, maybe for me, my own projection is probably, if what is addressed, will probably say around 20%. But I think 15% is a lot.
So we're looking at 20%. Thankfully, the president has prioritized security and defense in this proposed budget. We've seen about 4.91 trillion naira allocated for security, and hopefully that will solve the problem of the insecurity in the north. That's the headers, clash with the farmers, and we'll probably have our farmers back in the farm to be able to produce, and so we can be domestically secure in terms of food production, and we don't have to look to importing from our neighboring countries. Because just the news that came out, we see that onion prices surged more than 108% just because Nigerians were trying to source from our neighboring countries like Ghana, Cote d'Ivoire, and the rest of them, Benin Republic, just to get onions into the country. So just within 1 year, from 2023, December 2023 and December 2024, we saw that price surge of 108%, and that moved from about 120,000 per bag to about 250,000 naira per bag. That's a huge one, and hopefully we'll see that change in 2025. But with the ballooning debt, our debt profile is about 134. The last data we had from the DMO was about 134 trillion naira. And if we look at the debt capital expenditure versus the recurrence that's in the proposed budget, we see that, slight, not so, it's just a margin of like 14.85 for capital expenditure and 14.12 trillion for the recurrent non-debt expenditure. How do you see the government able to manage this debt profile, especially the fact that we need to generate more revenue? I know they've mentioned the taxes, but what other forms, what other avenues, alternatives can the government look into to be able to manage this and be able to, get projects on board that will generate in the long run, revenue for the country?
Well, I think that the part of the major concern that the DMO is having is the fact that once yield is attractive, it means that government is borrowing at a very high cost, and that's the major concern for DMO. And so they will want to do everything possible to ensure that they reduce the amount of debt that is being serviced through reduction of the yield, as well as trying to make sure that we do not have to borrow more than we need. So for me, government needs to diversify the economy. We have to look at We have to look at the non-oil sector. We have to look at solid minerals, for example. We have to look at the increased production in. We have all what it takes in terms of the climate, good the weather to be able to produce, to be successful in agricultural production. So government has to look at all that, and then of course tourism as well. I mean, for example, Qatar has majorly gas, and then they are doing so well in the economy because they, apart from revenue from gas, they have also diversified into tourism. So we've got a whole lot that we can, as a government, as a people, introduce to be able to diversify our earnings. I appreciate the fact that this current government is obviously trying to do, diversify this. They've introduced some form of guidelines as regard mining, which is very good. But we also need to do more. But in the meantime, while we are trying to diversify, I think that the government should focus more on trying to, to increase production so that we can earn enough and then ease the pressure on the FX. And of course, encourage the private sector initiatives in terms of oil production. The refineries are still not working 100%, but I'm sure that once these refineries work 100%, then we begin to, produce at least refine at least what we can utilize here before sort of, earning abroad. So for me, we should address this pressing issues first, and then, of course, diversification and will go hand in hand with the government projected policy. And
Uh,
if that is done, of course, this demand we reduce, and then we start seeing appreciation in naira, and then of course, if the inflation of 15% will obviously be met.
Fantastic. So let's look, before I let you go, just one quick question to let you go. Let's go with the rule on the road there. This is the first trading day. What instruments are investors playing at intraday? You share very quickly with us.
So well, everybody is trying to play safe. Today is the test work day. Yeah, so, but what we've seen so far is that a lot of the players are on the treasury bills, especially the 1 year NTP that was auctioned last week, came out around the 2.9, 2.8 level. So the major concentration is on that on that bill. For bonds, bond is on the fire side. I mean, of course, people still trying to access their book, and then hopefully by next week we start seeing activities on the picnic. But presently, T-bills is what is active for today.
Okay, treasury bills active in the minds of investors. Thank you so much, Chuka Nwachukwu, Group Head, Asset and Liability Management, UBA, for sharing your thoughts on Business Incorporated. So let's
Thank you
turn
very
our
much.
attention now to other markets. Middle East,